Climate disasters are driving insurance premium shock. Insurance pricing is no longer reacting to climate risk as a future scenario. It is responding to losses already absorbed and to exposure insurers no longer believe can be priced safely under existing models. Across the U.S., premium increases tied to climate driven disasters are appearing before new regulation, before formal enforcement, and often before companies adjust their own risk assumptions. That timing shift matters. It signals that insurance markets are now acting as one of the earliest mechanisms through which climate risk becomes an operating constraint. Nowhere is this more visible than in wildfire-prone regions of California and hurricane-exposed markets along the Gulf and Atlantic coasts following the 2024 storm season. Losses are no longer anomalies. They are annual baselines. According to the National Oceanic and Atmospheric Administration, NOAA, the United States experienced $27 billion weather and climate disasters in 2024, placing the year among the most costly on record. Hurricanes, severe convective storms, flooding, and wildfire events accounted for the majority of losses. From an insurance perspective, the problem is not a single extreme year. It is that loss frequency is compressing, reducing the recovery window insurers once relied on to rebalance portfolios. Reinsurance data reinforces this shift. Munich Re estimates that global insured losses from natural catastrophes reached roughly $140 billion in 2024, with North America representing the dominant share. For insurers and reinsurers, this level of loss is no longer treated as an outlier. It is increasingly modeled as a recurring condition. That recalibration flows downstream quickly. Higher reinsurance costs, tighter underwriting criteria, higher deductibles, and ultimately higher premiums or withdrawn coverage. California wildfires are rewriting the insurance math. California offers one of the clearest examples of how climate disasters translate directly into premium pressure and coverage contraction. Data from the California Department of Insurance, CDI, shows sustained growth in the state's FAIR plan, the insurer of last resort, as private carriers reduce exposure in high-risk wildfire zones. As of early 2025, FAIR plan policy counts exceeded 550,000, reflecting a sharp increase over the prior 2 years. This growth is not driven by demand alone. It reflects non-renewals, tightened underwriting, and carrier exits in areas where wildfire risk is no longer considered diversifiable. As exposure concentrates in residual markets, premiums rise further, both inside the FAIR plan and in the shrinking private market that remains. At the national level, the U.S. Treasury's Federal Insurance Office, FIO, has documented that homeowners' insurance premiums rose approximately 8.7% faster than inflation between 2018 and 2022, with climate-exposed regions experiencing significantly steeper increases. While the data window predates the most recent wildfire seasons, it establishes a structural trend that has accelerated since. The signal is consistent. Wildfire risk is no longer priced incrementally. It is being priced as a viability question. Hurricanes are driving premium shock across multiple states. The 2024 Atlantic hurricane season reinforced similar dynamics across the Southeast and Gulf Coast. According to Munich Re, major 2024 hurricanes generated tens of billions of dollars in insured losses, with insured damage often representing a substantial share of total economic losses. These figures matter not just because of their scale, but because they compound losses from prior seasons in the same geographies. For insurers, repeated hurricane exposure tightens capital requirements and erodes tolerance for risk layering. The result is not simply higher premiums, but more restrictive policy terms. Higher deductibles, reduced wind coverage, narrower flood endorsements, and stricter building requirements. From an operational standpoint, this changes how facilities, real estate portfolios, and supply chains are evaluated. Assets can remain compliant and technically resilient while becoming commercially difficult to insure at acceptable cost. Insurance is becoming an early warning system. Insurance markets are responding before new climate regulations take effect, formal enforcement actions increase, capital markets fully reprice climate exposure. Premium increases, non-renewals, and coverage exclusions are appearing upstream of governance and disclosure consequences. In practice, this means insurance is functioning as an early warning system for where climate risk is already operationally binding. For organizations, the risk is not simply higher premiums. It is that insurability itself becomes uncertain, complicating site selection, expansion plans, financing, and long term asset strategy. Insurance is not waiting for regulation to catch up, and increasingly, neither can the companies that depend on it. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.